Open a few institutional portfolios lately, and SpaceX seems to be everywhere. One large investor after another appears to have a giant position. The headlines practically write themselves, smart money is piling in. But there is a question hiding behind that story. Did all of these institutions suddenly buy SpaceX? Or did SpaceX suddenly become visible? Those are not the same thing. And confusing them can turn a useful filing into a very expensive conclusion. The short answer is this. A big position can appear in a 13F filing without being a brand new trade. To understand why, you need to know what a 13F actually is. It is not a live portfolio feed. It is not a receipt. And it is definitely not a message telling you what to buy next. A Form 13F is a quarterly report filed by institutional investment managers that control at least $100 million in certain securities. It lists eligible holdings at the end of a quarter. Then it can arrive as much as 45 days later. So when you see a filing in August, you are usually looking at a snapshot from the end of June. The market may already have changed completely. That delay matters, but the bigger limitation is what the form leaves out. A 13F covers only securities on the SEC's official reporting list. It does not show every asset an institution owns. Private equity can sit outside it. So can many hedge fund positions, real estate, private credit, cash, and other investments. Think of a 13F as one window into a building, not the building itself. Now imagine an investor owned a piece of a company while it was private. That holding would not normally appear in a public 13F report the way an eligible public security can. Then the company lists, changes status, or becomes reportable under the relevant rules. Suddenly, the position shows up in a filing. To the public, it looks new. To the investor, it may be years old. That is the hidden mechanism behind a lot of who just bought this. Headlines. The filing may reveal a new fact to you. It does not automatically reveal a new decision by the investor. With SpaceX, that distinction is especially important because the company was private for years and large institutions could have gained exposure long before a filing made it easy for everyone else to see. But a 13F does give you some useful clues. You can see the number of shares reported. You can see the quarter-end market value. You can compare the position with other disclosed holdings. And after several quarters, you can see whether the share count is rising, falling, or staying roughly the same. That is valuable information. It is just a very different kind of information from a trade alert. What you cannot see is often more important. You cannot see the investor's cost basis. You cannot see the exact day the shares were purchased. You cannot see whether the position was built gradually, received through a conversion, or held through a private vehicle. You also cannot see the full portfolio context. A position that looks like half of a disclosed stock portfolio may be a much smaller share of the investor's total assets. That last point is where many headlines go wrong. Suppose SpaceX is 50% of an institution's disclosed 13F holdings. That sounds like an all-in bet. But if the institution also owns billions in private companies, bonds, funds, property, and cash that do not appear in the form, the real concentration could be far lower. The percentage can be true, the interpretation can still be misleading. This is why big 13F numbers create such powerful reactions. They combine a famous name, a famous company, and a number that looks precise. Your brain fills in the rest. They must know something, they must have just bought, and maybe I should follow them. But the filing does not prove any of those things. It tells you who reported a position at one point in time. That is the beginning of research, not the end of it. There is another trap. Market value can make an old position look like a new conviction. If a stock rises sharply before the quarter ends, the value on the 13F can explode even when the investor never bought another share. The opposite can happen too. a smaller reported value does not always mean the investor sold. The share price may simply have fallen. That is why the share count matters more than the headline dollar value when you compare filings. So, how should you read a SpaceX filing without getting trapped by it? First, check the period and date. Is this current information or a snapshot from weeks ago? Second, compare shares, not just dollars. Did the number of shares actually change from the prior report? Third, ask whether the security may have become newly reportable. A first appearance can be a reporting event, not a buying event. Fourth, separate the company from the filing. SpaceX may have a compelling business story. Launch services, satellite connectivity, government contracts, and future technology ambitions can all matter. But none of that becomes more or less true just because a famous institution appears on a spreadsheet. The company's economics, spending needs, competition, governance, and valuations still need to stand on their own. And this is where the real investor question begins: who pays for the growth? What does the company have to spend before that growth becomes cash flow? Which parts of the story are proven today, and which parts depend on a future that has not arrived yet? Those questions matter far more than whether a fund manager's name is beside the stock. Smart money can be early. Smart money can be patient. Smart money can also have a very different time horizon from you. An endowment, a venture fund, and an individual investor do not play the same game. One institution may be able to hold an illiquid or volatile position for years. Another may have access to private rounds, different tax rules, or a portfolio large enough to absorb a painful loss. That does not make its position useless to study. It just means copying it without context is not analysis, it is outsourcing your judgment. So here are the 3 things worth watching next. 1. Future share counts. That is the clearest public clue about whether a reported holder is adding or reducing exposure. 2. The company's own disclosures. Revenue, spending, debt, margins, contracts, and cash flow tell you more about the business than a portfolio screenshot. 3. The difference between a headline and a mechanism. SpaceX did not become interesting because it appeared in big portfolios. Big portfolios became interesting because SpaceX appeared in a form that made their holdings easier to see. That is the reframe. The next time a giant fund discloses a famous stock, do not ask only, what did they buy? Ask, what exactly did this filing make visible, and what is it still hiding? That question will not give you a shortcut, but it will help you avoid turning delayed, partial information into a decision you do not understand. This video is educational information, not financial advice. Always do your own research before making investment decisions.